Well, I'm here with Daniel from Prerequisite Capital Management, and we've been talking about some of the different asset classes, and today we're going to be talking about currency markets and how we analyse them.
Yes, so currency markets are probably one of the biggest in the world, probably the most important and probably the most neglected by a lot of investors, basically. For good reason, in that they're actually a lot more opaque in the drivers of these things than, there's lots of theories, lots of opinions and lots of contention, but there's limited, reliable, solid data set and even first principles frameworks as to what is driving the movement of capital around the world and how do you trace it more accurately or in a more of a data-driven way. It's complicated from a number of different perspectives, because even between banking systems, there'll be an in-substance movement of capital, but without the transfer of money sometimes, and so and some of the movement of money or economic activity and capability around the world happens in a way that doesn't necessarily even get picked up by balance of payments type frameworks accounting, which is a bit of a throwback from 70 years ago, and it's a very different world today than what it is back then. And so trying to trace the flow of money and the movement of capital around the world in some ways is it's quite an effort.
It's a challenge.
Yes, and we're kind of revisiting here in a very direct way that whole point that we've been talking about frequently in different subjects and topics around following the money and looking at participant behavior and all of this sort of thing. And so it's exactly the same with currencies. We want to identify the different participant groups. We need to identify and understand their proximity to information and incentives, experience, sophistication levels, etc., how they interact typically with a cycle, in this case with currencies, etc. And so we try to triangulate all of that participant behavior and then watch, we've evolved ways to watch the way money moves and how positioning works and substructures in markets, especially for currency markets, in order to at least have an ability to glimpse beneath the surface of what's going on at a surface level with currency price movement.
Yeah.
Now, if you're an investor, especially with an international focus, currency is it's the gateway that you have to step through to access international assets and come back through. And on top of it, if you're content to live in your particular country forever and not actually venture overseas, then maybe you'll get away with not really having making decisions concerning currencies. But even then, there's issues around, if currency movement is to excess and too extreme, then that can totally restructure the very economy
that you're a part
that you're in.
Yeah, that's right.
And that can change the prospects for your business or your industry or your income source or whatever, or whatever savings you have. And so the currency markets and being able to develop at least a more informed view of what is likely going on and the health of trends and why capital is moving, etc., especially to try and do it in a more objective way. Obviously, we've wrestled with this for a long time, and in many regards, some of the tools that we've actually evolved and been able to apply to other markets were originally kind of refined or came out of this problem of having to gain insight into currencies and capital flows. And in many regards, I used to think about, if for an individual equity or a stock or even the broad equity market, we can look at an equity as an ownership claim on a fundamental business that is operating and producing goods and services, earning money, etc. But then we also need, so that's one framework, we also need a framework to look at the stock, so the traded security, the share of that company, through a currency lens. So how does the flows, the liquidity, the positioning, and all of that sort of thing impact? And so we're analysing a stock both from a fundamental perspective and from a currency perspective.
Yeah, of course, yeah.
And so once again, this all ties together, and I can't pull on one string without attaching into so many other realms. But anyway, so in this in this video, we're going to just briefly talk about some of the elements, probably some of the more unique elements in terms of how we approach this currency problem.
Yeah, great.
And as with most of our frameworks and tools, it's not necessarily perfect, but I'd like to think it's probably in that least bad category of how to deal with these issues and form probabilistic, useful insight that helps us manage investment portfolios, whether it's on a rolling 6-month basis or a rolling 10-year basis. Obviously, the more you get into broader time horizons around currency, the nature of the framework sort of evolves. We do get more towards first principle type considerations as the time frames blow out.
Yeah.
But yeah, and so we typically will analyze any currency from a structural sort of multi-year, even the prospects over the next decade sort of basis, and that does tend to be a little bit more first principle, and it gets down into, so most capital moves as a result of shifting expectations around growth and inflation and or safety of capital. It's usually some combination of those three.
Yeah.
And so when you get into the longer term prospects, you really start to deep dive into what really gives rise to growth and inflation and safety and all of these different issues, and then doing that analysis on a bit of a comparative basis between the different regions or the currency realms around the world. And it also goes to the sustainability of banking systems and all this in their different forms in different parts of the world. When we zoom back in to, say, a rolling 2-year time horizon, obviously it's a little bit more flow-based, positioning-based, and looking beneath the surface at market structure, and is this trend sustainable or is it starting to weaken? Does the market recognize this? How are they positioned? What are the feedback loops that are contributing to this capital flow dynamic? Is it likely to persist? Is it due for a pause? Et cetera, et cetera. And so some of these charts that we'll go through are just more examples of how we sort of skin that cat.
Yeah, great. So I guess, can you give us context for building out a framework for analysing this particular market?
Yeah, well, currency markets are the more practical side of things. So there's 3 main things that we need to look at when looking at any given currency. First, obviously, relative trends between the 2 different regions that we're talking about. We still need to be cognizant of the broader context that relative comparison is happening within, because that can still affect behaviours, because everything's connected to everything else, Relative trends, actual capital flows or the movement of money and participant positioning, etc., and thresholds of behaviour, so shifts in system structures and different things. And so the relative trends between the 2 different regions are really going deeper into the economic sort of growth and inflation conditions and expected sort of prospective conditions in the time horizons to come. How capital will be treated, risks of capital controls or any other sort of issues that could be unpleasant, negative surprises over whatever time horizon we're analysing, to relative banking system, the very nature of them. There's usually quite significant differences between regions, and then the inherent prospects and progressions or sustainabilities of different dynamics within those different banking systems. And then obviously the movement of money, which we'll go into some charts in a moment, but these thresholds of a shift in behaviour is incredibly important to be aware of. Right. And so what are those areas? Because in complex systems, they typically operate within a bit of self-reinforcing structure that sort of underpins these core trends and things, and they sort of fluctuate within certain ranges and areas and up against these thresholds. And if they actually break these thresholds, then the system reorganises itself to some degree, and we're actually into a materially different regime. Right. In practical market talk, that's more like a change in trend in terms of a longer term simplistic expression of that. And so we need to know where are those key levels, which if the currency market sort of trades through, is going to fundamentally trap a significant proportion of participants in that market. Because when they're trapped, they're forced to unwind. And that's where you get this cascading market, either to the downside or upside, depending on. And so we need to know those levels in advance. We need to know where those high probability pain thresholds are that will cause that shift of behavior in the different participant groups. Not knowing that can get you, trapped. You don't want to end up being that in that party that gets trapped.
Absolutely.
Or in that group that gets trapped, and the market's cascading against you. And so that's the basic overview in terms of getting to some practical tools and ways
show us how that works.
Actually looking at some of that. Now, this is just a sampling. Obviously, depending on the time horizon and all of this sort of thing, there's different methodologies and different levels of depth we need to go to. This is a little bit more of the shorter, say, a rolling 2-year kind of basis dynamic. So we have relative, banking system conditions. This is a bit too in-depth to go into right now. Relative equity market growth type proximate conditions, yield spreads. Some of this is reasonably conventional, but it gets very different when you start to integrate this in that systems view, where it can have very different meaning at different points in time relative to a pricing structure, relative to what relative banking system liquidity is doing. This is actually a classic oversimplistic example of how those relative trends in banking systems really matter, because up here, so this is the euro area banks, or bank stocks, relative performance to the rest of the world's bank stocks. So when it's rising, the euro banks are improving or performing better than the rest of the world, basically. And when it's falling, the light blue, that's when European banks are performing worse than the rest of the world, simplistically speaking. And then obviously this is the euro-US dollar currency pair in dark blue. It's up until 2007-ish, didn't really have a lot of issues in European banks. We actually had a lot of issues in European banks. They just hadn't come to the surface yet, but that's another story. And then increasingly the deterioration in that banking situation and the broader European economic system continued to deteriorate to the point where none of these rallies in the euro. So that's a strengthening euro against a weakening US dollar, not confirmed by similar outperformance in the European banks. And so that diverged, so that was transitory. That was very weak, so that was transitory. This was lethargic, so that was transitory. And here we go again, that's probably going to be transitory. This is a simplistic way of assessing that. And really, especially when you go to a multi-year sort of time horizon, you need to go much deeper fundamentally into what is actually happening in these two different banking systems. But this illustrates the point simply enough. When we skip over to the money flow sort of tools and the underlying liquidity that we've talked about, you can see here, so it's the same euro-US dollar currency pair. So all of these tools and the things that we go through apply to every currency pair. Even the really random ones, the cross currency pairs that are less, prominent. Same methodology, all of this still applies. Even here, back in 2000, 2001, the euro was very weak, sentiment was washed out, being accumulated by patient, larger money in the world. Speculative money flow in a currency context is kind of like it's basically the hot money flows, that people talk about in that currency sort of world, that can be quite destabilizing at times, especially in emerging market contexts. Underlying liquidity started to really just go through the roof, so that globalized system is placing a lot of value that is not being recognized by the markets just yet on that euro currency region, generally speaking. So there's a lot of non-active, non-analytic business, financial flows and sort of more of a passive nature funneling into the euro area, but it's not yet being picked up by broader awareness, and definitely not by participants. And so that's a typical setup of, we need to sit up and pay attention to what's going on in Europe, for example, relative to the US, and, all the way through. And so here we're back at an over-speculative condition, hardly, even approached previous highs in price before we've kind of gone off the charts. Every time we get over-speculative, it's typically a significant turning point. Liquidity is falling away, quite a weak picture there, it's not confirming. And so, this all sort of adds to a picture. And, if we go back to the simple representation of, relative banking prospects, you can see that's falling away. This is likely to be transitory in nature, et cetera, et cetera. And so more different ways of understanding net flows. The liquidity turning point signals are extremely useful in currency markets.
Yeah.
When they trigger, it's a greater than 70% probability of a trend change or a correction or a shift, because it represents a critical mass in participant positioning underneath this market. So it's there's too much unity, too little diversity in the positioning of participants and the way they're interacting with the market. And so we get these triggers, and when they trigger but they don't have much price sensitivity to them, it kind of betrays the inherent underlying strength of trend.
Yeah.
So even in a failure of signal in that 30% of the time, it just shows how strong. So here's one that failed, but man, that was an indication of how strong that trend was, and subsequently we even got a failure there as well, and it just kept going. The hollow diamonds are more of a minor signal whereas the filled in ones are major signals. So even here we have got basically a failed one. So this is still an incredibly weak market.
Yeah.
And hypersensitive here, right, to that minor signal that triggered. And so this is still an inherently weak market, which is what the flows are telling us anyway. Over speculative, underlying liquidity is actually moving more towards the US than Europe. In terms of thresholds, so this is the real money threshold. So this is actually the US dollar index, right? So the US dollar index is basically an index of the US dollar against the euro, the yen, and the pound, and a couple of smaller ones. It's basically just the euro in effect, but the pound and the yen do have some influence, but this is sort of like the opposite of the euro, more or less. But it's a good example of, so we can see these are the real money bullish community in the world. So anyone with committed or uncommitted capital that needs to form a view on the US dollar index in this context. When we're above the line, that's basically they're confident, they're in control, they're probably in the money. They tend to have that portfolio overweight condition towards US dollars in this case, or short euros in a sense. When they're below, that's where they get trapped. So see here, we kind of cross that threshold and it just collapses. We get that cascading thing where they're overcommitted to the US dollar, and they got to reverse, get their money out. They're trying to minimize losses or pay up in hedging and whatever. On the flip side, the real money bears, right? And markets will often tend to move just enough to trap. Markets have a bit of a sadistic nature about them in a way. In a bull market, they'll move just enough to trap those the US dollar bulls in this case, real money, and then that will mark the turn. Just enough to trap them, and then we're off. Just enough to trap them again, and then we're off. It looks like we might be going to another trap as well, and that sort of builds the potential energy. Whereas the bears have been massively in control after they've been basically in a lot of pain. Right, and you get the idea. And so the same works on a nearer term, more tactical basis with the leveraged money community or the more speculative community. We can see the same thresholds and points, and we know the price levels that basically represent, in terms of real money bulls and bears, where those pain points are. If crossed, that's high probability that market's going to cascade. Same with the leverage community. Obviously, it's a lot tighter the levels tend to be before they get trapped and are forced to reverse, because they're using leverage, and so they're more hypersensitive to any movement. It's really interesting when obviously a participant group gets trapped and there is no cascade. It betrays inherent strength or their inherent underlying conditions and trends. So it's been tested. The opposite group should be trapped, but the market couldn't cascade or move, and so it's like a huge signal in terms of where the market's really at and likely to head. And so it's insight into what's going on, so we can better understand flows and positioning and critical mass conditions that could lead to a turning point in some way, shape or form, or a big change of trend. So obviously this was just a sampling of some of the methodologies we have. It's a little bit more geared to a shorter multi-year basis rather than longer multi-year sort of time horizon type decisions around currencies. But you can get an idea of how we kind of approach that, because we need an objective framework. We need some objective, testable assumptions that we lean upon and beliefs about how this market actually functions that then translate into practical analysis tools, which we've probably got plenty of, reducing all of these concepts into operationalized tools. And then that helps us to frame the all-important currency question, especially when it impacts portfolios.
Yeah, absolutely.
And we run reasonably conservative mandates, but they have an international footprint to them. So we really need to be on top of our game as to what is going on in terms of the way capital is moving around the world, and the possibilities for that, future behaviour and movement, 1, 5 and 10 years, from now. But obviously always paying attention to what's going on in the moment, to assess the reasonableness of those assumptions and the way capital is behaving, so we can have a bit of degree of foresight arise. And we need to know the underlying health of trends or otherwise, and also where those thresholds are. So if we need to get out of the way, then we probably need to be, paying more attention when we start to get to those levels. In a portfolio context, obviously we need to be very careful at how we balance currency exposures in the portfolio. It's a very important moving part. And obviously in our portfolios, we don't use derivatives or leverage or any of this sort of thing. And so, we're typically, as a general broader philosophy, looking for, best assets in the best currency kind of regions in the world, and tend to want to have at least a bit of exposure to them if, for that international kind of component of our different mandates.
That's great.
And that's just another moving part that helps us build out resiliency, which we've talked about in other videos.
Yeah, great.
But that's basically
Thank you for giving us some great insight into currencies, and also your unique approach to how you see them. Thank you.